Richard Dennis uncovered the turtle strategy that changed trading. When a trader first looks at the chart, it may appear as nothing more than numbers and lines moving up and down. Green candles, red candles, highs and lows, bars of volume beneath them. Yet behind this shifting data lies something far deeper. The market is not a cold machine. It is a living reflection of human psychology. Every tick, every fluctuation is an echo of what millions of people are thinking, feeling, and acting on at the same moment. To truly understand market movement, you must step beyond the mechanics of indicators and formulas and begin to recognize the crowd's emotions displayed on the screen in real time. Greed is perhaps the most obvious force at work. When prices rise quickly, greed spreads like wildfire. Traders who have been sitting on the sidelines suddenly feel compelled to jump in, convinced they will miss a life-changing opportunity. The late entries, the frantic buying, the euphoric chatter on social media, all of it shows up in the price action as sharp vertical climbs and overextended trends. But beneath that excitement is fragility. Just as quickly as people rush in, they can rush out, and what looked like strength becomes weakness. A seasoned trader, operating with a disciplined mindset, sees these bursts of greed not as opportunities to chase, but as warnings of unsustainable emotion driving the market higher than logic support. Fear works with equal intensity. When negative news strikes, or when a strong trend begins to crack, the chart reveals panic. Candles stretch downward with speed, stop losses get triggered, and traders who once swore they would hold for the long term dump their positions in desperation. This cascade of selling is not driven by rational analysis of company fundamentals or economic data. It is pure human psychology, expressed in red ink. To the disciplined trader, this isn't chaos but clarity. They see the fear in others and recognize that the market has become an exaggerated mirror of panic, often presenting the very best opportunities for entry when everyone else is blinded by emotion. Hesitation is another psychological layer often overlooked. On many days, the market doesn't explode up or crash down. Instead, it drifts sideways. This reflects uncertainty in the crowd, a lack of conviction, and indecision about where the next move should go. These periods frustrate impatient traders, causing them to overtrade, force setups, and give away their capital. But the trained trading mindset views hesitation as part of the natural rhythm of market. Just as people in life hesitate before making big decisions, the market hesitates before its next large move. Observing this calm and waiting with patience often allows the disciplined trader to anticipate a breakout when others are caught asleep. Conviction is the rarest of psychological states that the market mirrors. It occurs when the majority of participants align in belief. This can be seen in clear trending markets where price action moves steadily in one direction with strong volume confirming the path. It is the point where belief becomes confidence and confidence becomes action. Yet conviction, while powerful, eventually attracts the crowd. And when the crowd arrives, the opportunity for outsized gains often begins to decline, because the trade is no longer a secret. It has become consensus. A trader with the right mindset understands that conviction is a double-edged sword. They respect the strength it brings, but also prepare for the moment when that strength flips into exhaustion. The real mastery of trading lies in learning to step back and watch the psychology unfolding. Just as a psychologist observes human behavior in a controlled experiment, every spike, dip, reversal, and consolidation is not random noise, but the output of emotions magnified through money. By recognizing the recurring cycles of greed, fear, hesitation, and conviction, a trader begins to see the hidden story behind the price. The market is no longer just a battlefield of numbers. It is a mirror reflecting back the collective psychology of those who dare to participate. And once you see the market in this way, the charts transform from confusing patterns into a language that can be read, anticipated, and understood. Every trader at some point learns to watch price, but very few pay the same attention to volume. Price shows direction, but volume reveals conviction. It is easy for a market to move a few points on thin trading. It is something entirely different when heavy buying or selling floods the tape. The difference between activity and commitment is critical, because activity can be fleeting, while commitment changes the course of a trend. Understanding volume is like peering behind the curtain to see whether the actors on stage are truly invested in the performance or merely playing roles without substance. When volume is low, the market whispers rather than shouts. A stock may climb or fall, but without meaningful participation, those moves lack durability. Traders who chase low volume rallies often find themselves caught in traps, buying at the top of a hollow move that quickly collapses. This is because price without volume is like a house built on sand. It looks stable, but crumbles when pressure mounts. A disciplined trading mindset respects this truth. Instead of being seduced by the illusion of a move, it demands confirmation. Is the crowd truly committing their capital, or is this just noise created by a handful of impatient players? In contrast, when volume surges, the market speaks with authority. Imagine a breakout where price pushes beyond a resistance level that is held for weeks. On light volume, that breakout is fragile. It can fail as soon as a small cluster of sellers appear. On heavy volume, however, the story is different. The breakout is supported by strong participation, a wide base of traders and institutions placing real money on the line. This is not just activity, it is commitment, and it shows in the way price sustains itself beyond the initial thrust. A trader with the right mindset understands that such volume-backed moves are not to be ignored, for they often mark the true beginnings of major trends. Volume also tells the story of distribution and accumulation. Even when price seems quiet, there are times when a stock trades sideways, moving within a narrow range, seemingly uninteresting to the average observer. But look beneath the surface. If volume is building during this quiet consolidation, it often signals that large players are accumulating positions, carefully loading up before the real move begins. On the opposite side, when a stock is near highs and volume spikes with little progress in price, it often reveals distribution, with smart money selling into strength while the crowd still believes in continuation. The chart may appear calm, but volume reveals the hidden battle taking place. A trader who develops sensitivity to these patterns can begin to anticipate shifts before they happen. Consider how stop hunts work. The market pushes beyond a key level to trigger stops, creating the illusion of strength or weakness. Many traders rush in, but the experienced eye notices that volume did not confirm the move. Without commitment, the breakout fails, trapping the inexperienced while rewarding those who waited for confirmation. This is how volume separates the noise from the genuine intention of the market. Beyond technical setups, volume reflects the psychology of participants in real time. When fear grips the market, the surge in volume is unmistakable. It is the sound of stops cascading, panic selling, and traders capitulating. When greed takes hold, the buying frenzy drives volume to extremes as latecomers pile in, desperate not to be left behind. In both cases, volume is not just a measurement of shares traded, it is a thermometer of crowd emotion. Reading it correctly allows a trader to step aside when risk is too high or step in when opportunity is strongest. Even institutions, the so-called smart money, leave their fingerprints through volume. They cannot move in and out of positions without leaving a trail, and that trail is most visible when sudden surges in participation appear. Retail traders often get lost in patterns and indicators, but the disciplined trading mindset understands that following the weight of capital, the commitment shown in volume, is a far more reliable guide. It shows where the real battle is being fought and which side is putting more skin in the game. The lesson for a trader is simple yet profound. Do not judge a move by price alone. Look to the strength of the crowd standing behind it. Ask whether the market is merely active or whether it is truly committed. The answer is always written in volume, and learning to read that answer with clarity becomes one of the greatest edges a trader can possess. In every market, traders often believe that price moves simply because of supply and demand. While that is true at the broadest level, there is an invisible hand that shapes how those forces actually play out in real time. That hand is liquidity. Liquidity is what allows large players to enter and exit positions without causing chaos. And it is also what traps smaller traders into thinking moves are natural when they are in fact carefully engineered. The market does not move randomly. It moves toward where liquidity sits. Understanding this fact changes the way you see every candle and every sudden spike, because liquidity is the silent puppeteer pulling the strings behind the show. Liquidity is nothing more than the availability of orders in the market. Buyers waiting to buy and sellers waiting to sell. But to the trained trader, it represents something deeper. Each cluster of liquidity is like a magnet. When stops pile up above resistance levels or beneath support zones, they create pools of liquidity. The market, driven by larger participants who need liquidity to fill their massive orders, hunts those pools. What looks to the inexperienced trader like a breakout or breakdown is often nothing more than a liquidity grab. The silent puppeteer does not move price to confirm a trend. It moves price to harvest liquidity and feed the needs of the bigger players. Consider the common scenario of a stop hunt. A trader sets a stop loss beneath a support line, believing it to be a safeguard against losses. But when thousands of traders place stops at the same level, it becomes a honeypot of liquidity. Institutions know this. They deliberately push price just beyond that level, triggering a cascade of stop orders that provides the liquidity needed to enter their long positions at a discount. To the untrained eye, the break of support looks like weakness. To the trading mindset that understands liquidity, it is the puppeteer's hand pulling price down only to scoop it back up once the stops are clear. The same dynamic plays out above resistance zones. Retail traders often see a breakout and rush to buy, afraid to miss the move. But if volume does not confirm and the breakout stalls, it may have been engineered purely to capture the liquidity of stop orders placed by short sellers. Once those stops are triggered, providing the liquidity institutions need to offload their positions, price often collapses back into the range. The breakout was never real. It was a puppet show designed by liquidity's invisible hand, fooling those who do not understand who is really in control. Liquidity also explains why markets sometimes seem to defy logic. News may be overwhelmingly negative, yet the market rallies, or positive headlines dominate, yet price stalls or even falls. This is not because the news has no impact, but because liquidity dictates the path. If a flood of buy orders has already been positioned ahead of the news, institutions may use the event to sell into that buying pressure. If liquidity is sitting above current price, the market may rise despite bad news simply because it needs to grab that liquidity before moving in the opposite direction. Traders who do not see this dynamic remain trapped in the illusion that news moves the market, when in reality, liquidity is the master choreographer. Patience becomes critical when trading with this understanding. A disciplined trader knows not to chase the first move. They watch carefully where liquidity might be resting, where stops have likely been stacked, and where big players are most incentivized to hunt. Instead of falling for the trap, they position themselves where the puppeteer's hand is guiding the string. They recognize that true moves usually begin after liquidity has been harvested, not before. This mindset turns what appears as chaos into clarity. Sudden spikes, sharp reversals, false breakouts. They are no longer mysteries or accidents. They are liquidity-driven plays engineered with precision to exploit the predictable behavior of the crowd. Once you understand that liquidity is not just a background concept, but the very mechanism through which large capital operates, you begin to see why the market behaves the way it does. Price is not simply a line moving up and down, it is a puppet, and liquidity is the puppeteer that decides where the strings will be pulled next. One of the hardest truths for traders to accept is that the market often moves in ways designed to confuse and mislead. The path to profit is rarely straightforward. Instead, markets tend to create false moves before the genuine direction reveals itself. These false moves are not accidents, nor are they random noise. They are deliberate traps woven into the very structure of price action. They are engineered by the psychology of the crowd and exploited by those with deeper pockets and greater patience. To the inexperienced eye, a breakout looks like opportunity. A breakdown looks like danger. To the trained trading mindset, these are often the precursors, the fake gestures that disguise the true move waiting to unfold. False moves can take many forms, but one of the most common is the failed breakout. Traders watch a resistance line closely, convinced that if price finally pushes above it, momentum will carry it higher. When that breakout occurs, they rush in to buy, but very often, the breakout does not hold. Instead, price quickly reverses, collapsing back below the resistance line. Those who bought the breakout are left trapped, their stops triggered, their positions liquidated. To them, it feels like betrayal by the market. In reality, it is the market harvesting liquidity. The false move above resistance created the conditions for the true move downward, shaking out weak hands and rewarding only those who had the patience to wait. The opposite occurs with breakdowns below support. A sharp move lower convinces traders that the floor has given way and that selling is the only rational choice. Panic spreads, stops are triggered, and late sellers rush to exit. Yet just when fear reaches its peak, price reverses violently upward, leaving the shorts trapped and fueling the rally. The breakdown was never the true move. It was the bait, the illusion created to fill the orders of those who were prepared to buy at the exact moment others were most desperate to sell. These patterns repeat because human psychology is predictable. Fear of missing out drives traders to buy the instant they see what looks like confirmation of a breakout. Fear of loss drives them to sell as soon as they see support break. The market understands this behavior, and the silent hand of larger players uses it to their advantage. By engineering false moves, they exploit the emotional impulses of the majority, taking liquidity at advantageous prices before revealing the genuine direction. A disciplined trader who embraces this truth learns not to chase the first move. They watch with detachment as price breaks out or breaks down, waiting to see whether volume and follow-through confirm the move or whether it is a false gesture meant to deceive. This waiting is not easy, for it requires going against the natural instincts of urgency and fear. Yet it is in that waiting that the real edge lies. The false move clears the board, eliminates the weaker players, and sets the stage for the real trend. Only those who remain patient and disciplined can seize that opportunity. False moves also occur in more subtle ways. A market may drift higher over several sessions, luring traders into believing in an uptrend, only to reverse suddenly in a single session that wipes out days of progress. Or it may grind lower, convincing participants that weakness is entrenched, before snapping back with strength that erases all those losses. In both cases, the true move hides behind the illusion of the false one. The market pretends to reveal its hand, but in truth it is concealing its intentions until the last moment. The trading mindset must internalize the lesson that deception is part of the market's structure. It is not personal, it is not unfair, it is simply the way the game is played. Those who are impatient and reactive become the victims of false moves, providing the liquidity for those who understand the deeper rhythm. Those who are patient and disciplined learn to see the false move not as a signal to act, but as a signal to prepare. They know that the market often takes one step in the wrong direction, precisely so it can take a stronger step in the right one. By recognizing that false moves precede true moves, the trader develops a calm detachment. They are no longer surprised when a breakout fails or when a breakdown reverses. Instead, they expect it, plan for it, and use it as confirmation. In this way, what appears as chaos to the untrained eye becomes a predictable sequence, one that rewards patience, observation, and discipline over impulse and emotion. Every trader has witnessed the chaos that follows a breaking headline. A company announces earnings, a central bank delivers a statement, or a political event shakes confidence, and suddenly the charts explode with violent movement. To the beginner, this looks like proof that news is the direct driver of markets. Yet the trading mindset sees something different. News itself is not the force that shifts price. It is the reaction of the crowd to that news that causes movement. Price action is less about the event and more about how human psychology interprets it. The hidden force is not the words written in the headlines, but the way they ignite fear, greed, or confusion in those who read them. Often, insiders and large institutions are positioned before the news ever becomes public. They understand that by the time information reaches the mass of retail traders, it is already priced in, or even outdated. A stock may soar in the days leading up to a highly anticipated announcement, only to stall or decline when the news finally arrives. To the uninformed, this feels contradictory. They ask, how can good news lead to a sell-off? The answer lies in the fact that the smart money used the optimism of the crowd to exit their positions at the best prices. News was not the real mover. The crowd's late reaction to it was. The reverse is equally true. Markets sometimes rise after negative headlines or fall after seemingly positive reports. This happens because traders do not trade the news itself. They trade their perception of what it means. If the majority expected something worse, bad news may come as relief, sparking rallies. If expectations were too high, even good news may disappoint, triggering sell-offs. The chart does not reflect reality. It reflects human interpretation of reality. A disciplined trader understands this subtle but powerful truth and avoids reacting blindly to headlines. News also amplifies existing emotions in the market. When fear is already present, negative news accelerates panic. When greed is dominant, positive news fuels euphoria. The market exaggerates in both directions. Because the herd reacts emotionally, rather than rationally, watching price and volume during these moments reveals how deep the emotion runs. A sharp spike with no sustained volume often means the reaction is short-lived. A steady trend with heavy participation suggests conviction. In both cases, it is not the news headline that matters most. It is the way the crowd chooses to respond. The skilled trader uses this understanding to stay ahead. Instead of being caught in the storm of emotional reaction, they observe the reaction itself. For example, if a stock delivers poor earnings but price refuses to fall further, it may indicate that sellers are exhausted and that the market has already priced in the negativity. On the other hand, if a company delivers record-breaking results but price struggles to hold gains, it signals distribution smart money using the crowd's excitement to sell into strength. Both scenarios reveal that the true story is not in the news, but in the market's behavior after the news. Patience once again becomes the defining trait of the trading mindset. The professional does not chase the first spike or dump on the first dip. They allow the initial burst of emotion to play out, knowing that the real move often comes after the dust settles. The crowd rushes in to react, while the disciplined trader waits to see whether that reaction holds or fades. In this way, news becomes less of a threat and more of an opportunity. The volatility it creates is not random. It is a window into the psychology of the masses. Another layer to this understanding is the realization that media outlets themselves profit from emotion. Headlines are designed to shock, to excite, to grab attention. The louder the headline, the stronger the crowd's reaction, and the more predictable the moves become. Recognizing this dynamic helps the trader detach emotionally. Instead of being drawn into the noise, they analyze it as part of the broader game. News is not simply information. It is fuel for the crowd's emotions, and therefore fuel for the price swings that disciplined traders can anticipate and use. The true secret is not trying to predict the news, but studying the reactions it generates. By focusing on the psychology of the crowd, rather than the words of the headline, the trading mindset transforms chaos into clarity. News will always come, markets will always react, and emotions will always surge, but it is the interpretation of those emotions that reveals the real opportunity. Every trader eventually stumbles upon insights about how the market really works. They notice how price moves toward liquidity, how volume confirms commitment, how false breakouts trick the crowd, and how news drives emotion more than fundamentals. These realizations are powerful. They are the market's hidden secrets, uncovered through study, observation, and experience. Yet possessing knowledge alone does not guarantee success. What separates the trader who thrives from the one who fails is not access to secrets, but the discipline to use them consistently. Discipline is the bridge between understanding and profit, the unseen force within a trader that decides whether their edge becomes reality or slips away in the heat of the moment. Discipline begins with patience. The market is constantly presenting illusions, tempting setups, and sudden surges that make the inexperienced want to act immediately. Without discipline, the trader jumps at every move, trying to force the market to deliver profits. This impatience is the undoing of many. The disciplined trader, by contrast, knows that waiting is often the hardest, but most profitable skill. They wait for confirmation, for volume to align, for liquidity to be swept, for the false move to reveal itself. They are not seduced by the first hint of action because they know the market thrives on deception. Their discipline gives them the strength to stay still while others rush in, allowing them to act only when the odds tilt heavily in their favor. Discipline also manifests in risk management. Knowledge of market secrets can quickly turn into overconfidence. A trader who believes they see the truth may begin to overleverage, risking too much on a single idea, convinced that this time they cannot be wrong. But markets have a way of humbling even the most skilled. The disciplined trader respects uncertainty. They know that no setup is perfect, no insight is absolute, and no secret removes risk completely. By controlling position sizes, by using stops wisely, and by never risking more than they can emotionally and financially endure, they give themselves longevity. Profits become sustainable, not because they never lose, but because they protect themselves so losses never erase their capital. Emotions are the true battlefield where discipline is tested. Fear, greed, frustration, and euphoria all rise in waves as price moves. Without discipline, these emotions dictate behavior. Fear causes premature exits, greed causes overtrading, frustration leads to revenge trades, and euphoria blinds the trader to risks. The disciplined mindset does not suppress emotion, it recognizes and manages it. When fear rises, discipline reminds the trader to stick to the plan. When greed whispers, discipline restrains the urge to chase. When frustration builds, discipline enforces the wisdom of stepping away. Discipline is the anchor that prevents a trader from being tossed around by the psychological storms that markets constantly unleash. The market thrives on inconsistency. It survives because most participants cannot remain disciplined. They may know the theory, they may understand the patterns, they may even have the right tools, but when real money is on the line, they abandon their rules, fall into emotional traps, and feed the liquidity machine. The disciplined trader survives because they resist this cycle. They do not need to win every trade. They need only to win consistently over time, letting their edge play out across dozens or hundreds of trades. Discipline ensures they follow their edge faithfully rather than sabotaging it with impulsive decisions. Discipline extends beyond the chart as well. It shows up in preparation, in journaling trades, in reviewing mistakes, and in building routines. Markets demand constant learning. Without discipline, a trader neglects this process, repeating the same errors until their capital is drained. With discipline, each mistake becomes a lesson, each loss an opportunity to refine. Over time, the disciplined trader evolves while the undisciplined remains stuck in cycles of hope and regret. It is discipline that compounds experience into mastery. Ultimately, every trader is faced with the same question. Will they act on knowledge, with consistency, or will they betray their own understanding in moments of weakness? Secrets of the market can be discovered by anyone who pays attention, but profits are only delivered to those who remain disciplined enough to apply those secrets again and again, no matter the temptation to deviate.